All right, y'all. In this session, we are going to be going over CVD, and this is going to tie together some of the loose ends from the last session. CVD stands for cumulative volume delta, and it's the running total of delta. It's very much so related to delta, and here's how we calculate it, okay? Right here, we can see a typical footprint bar statistics that we would see in our footprint chart, like what we have down here, where we have three main things. We have CVD, we have volume, and we have delta. Now, CVD stands for cumulative volume delta, and basically, we are just going to be adding the delta of the current candle to the previous candle. For example, right here, we see the first candle, we have negative 73 million CVD. Okay, now the second candle right here, we have negative 5.4 million delta. What we are going to do is we are simply going to now subtract 5.4 million from negative 73 million, and that's going to give us a negative 78 million cumulative volume delta. The reason why it's called cumulative is because we're literally just taking the delta from each candle and then adding or subtracting that to the previous candle's cumulative volume delta. So basically, the next candle, we have negative 95 million because we're removing 17 million from negative 78 million. Then we have a positive 6.4 million delta, so we're going to add 6.4 to 95 million. And you'll probably notice that decimal places are not really calculated here. So if we have, 500,000, that's not actually going to change the number of CVD. And if we have a decimal place like 6.4 million, that's not actually going to change the decimal place on the CVD. It's going to pretty much just stay the same. And we can see, if we come back to our chart here, that over time CVD also is going to go from negative to positive. For example, if we go back in time, to yesterday, we can see that CVD was in the negative. Okay, and it's color coded. It's going to turn purple as it's negative and blue as it's positive. It's very similar to the way delta is color coded here on our delta cluster candles. And the reason why this is so important is because this is really going to tell us over time what side of the market is more so in control. If CVD is continually going up, we know that over time there are many, many more market longs opening than there are market shorts. And if CVD is getting more purple over time, we know that more market shorts are opening than market longs. And CVD can be very, very useful to us because we can use it to infer many things about the market and where price is likely to go. So in trading, there are two types of trades. You have your market orders and you have your limit orders. These are known as active and passive orders. Market orders are active orders because you are marketing in and that order is immediately getting filled, where a limit order is more of a passive order because you have to set that limit and you have to wait for it to get filled. Now, the only way a limit order can get filled is if somebody else places a market order in the opposite direction, okay? What I mean by that is this. Let's say, for example, somebody has a limit order down here, and this limit order is, let's say it's for $100,000, okay? We're buying Bitcoin at $100,000 at the price of, let's just say, 30K. So somebody has a limit order set at $30,000 for $100,000 of Bitcoin. The only way that limit long order can get filled is if, as price, let's say, is in a downtrend, right? Let's say price is in a downtrend. The only way that limit long order will be able to get filled is if somebody places a market short order right here. So if somebody markets in right here for $100,000, okay, 100,000 at 30K, This is a short, okay? So just so that we are clear here, this market order that somebody is marketing in at 30K, this is a limit long order, okay? So I guess I can't edit that. So I'm just gonna have to do a new one here. All right, looks like this is not working out the way I want to. So this is $100,000 at 30K, a limit long, and this right here is going to be $100,000 at 30K market short. And essentially what is happening here is the person who's marketing short is essentially giving their money to the person who has this limit long, right? We have to understand that the only way this limit long is going to get filled is if somebody places a market short at the same level where this limit long is at. And so you can think of it as this person here literally just giving their money to this guy right over here. Okay, he's handing it off. The person who's marketing short is handing off his Bitcoin to this guy right here who is limit long. Okay, now we can look at this as saying, you know, the limit orders are providing liquidity to the market, and that's why Bybit used to give you a rebate if you had a limit order. Okay, now limit orders are used by larger traders most of the time who are trading with millions of dollars because they can't market in that large of a position. First of all, there will be market fees. Second of all, there will be slippage, so they won't really be able to get the entry that they want. That's why it's better for them to use limit orders. Now, the thing about footprint charts is that we are unable to get any kind of information about limit orders here. Everything that we see on this chart right here is telling us about market orders, right? I've been making this very clear from the beginning of these sessions. This is literally only showing us market orders. When we're looking at delta candles, when we are looking at CVD, when we are looking at volume and delta, it's only telling us about market orders. We have no idea who it has limit longs right here. We only know who is actively marketing in and out of the market. And so what CVD can allow us to do is it can allow us to know where these giant limit longs are. Okay, and here's why this would be advantageous to us. Here's why this would be advantageous to us. Let's say, for example, we have a downtrend, okay, for Bitcoin. We have a downtrend. The market's making a low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. Nobody would argue the fact that this was a downtrend, okay? Now let's say we're coming down to a key area of support right here, okay? Now, let's also imagine that there is a whale who has a $200 million limit order placed right here. Okay, now we would never be able to see this limit order on our chart right here. We would never be able to see it. We would only be able to see market orders coming in. Okay, and so if there is a very large limit order right here, we are basically going to be able to use CVD to find out where those limit orders are. And here's how. If, let's say, we notice that there are many shorts opening up right here, and yet the price does not come any lower, this is telling us that there are large limit orders at this level that are absorbing the market shorts that people are marketing into. Okay, let's say, for example, we see, and I'm going to go back in time to a long trade that we took recently here, a few days ago. because it really exemplifies the point that I'm trying to make here. It was right over here, okay? Right here, we can see that there are millions and millions of volume. There are 60 million shorts opening up right here on this one candle, right? However, we know and can see that the price, we would expect that the price would shoot down much, much farther than this. But instead, what happens? The price actually starts to come up. Why is that? It's because there is a limit order right here, okay? And all these shorts that are opening up are essentially filling a large limit order that's set right here. So if we do have a $200 million limit order, and we see that price is coming to a key level of support, and we see with the delta and the volume that millions and millions and millions of shorts are opening up, okay? Let's say that we have millions of shorts opening up. We have 50 million right here, 50 million coming in right here, 50 million coming in right here, 50 million coming in right here. Okay, each one of these shorts, let's say that each one of these shorts is worth 50 million, okay? So all 4 of these market shorts are equal to $50 million, okay? And we see 50 million, we see like for, let's say that we're watching our delta candle coming down here, and the delta candle, we've got this thing going on right here, and we see all this red delta, right? Red delta stacked like this. It's super, super red. We see a whole bunch of imbalances here, right? Where we have many more sells than we have buys. We see stacked imbalances as we're coming down to a key area of support, but we also notice that price isn't really coming down. In fact, it's starting to come up. What does that mean? It means all 4 of these market shorts are literally just giving their money to fill this $200 million limit long. So the price is not going down because there's a large limit order being filled as these shorts are being placed into the market. Essentially, this $200 million limit long is holding the price at this level. And then what can happen is if more longs start to step in here, then the longs will outweigh these shorts and price will have a reversal. And the way we are going to know that this is happening is because we can now see, if we turn on our open interest and our net longs here, we can literally see that as the price is coming down to the level and we have all these stacked imbalances, that all of a sudden price starts to reverse, and now we're seeing net longs. We see longs starting to step in. What this means is that a large limit order here was filled, and now because people are starting to market in long, the longs are outweighing the shorts, and now these shorts are trapped underwater. Okay, they're trapped underwater. That means price is going to continue squeezing those shorts and coming up from here. Okay, this is the general concept of what CVD is going to show us. And now I'm going to get exactly into how the CVD is going to show us that. Okay, so what we want to look for is something called a CVD divergence. A CVD divergence is a little bit different than a typical divergence that you would look for. Okay, so if we just go to google.com, it's a website I'm sure some of you may have heard of. I'm not sure, but some of you may have heard of. And we just type in divergences in trading. Okay, and we go to good old images and we go to the classic picture right here. Okay, you can see that there's 2 types of divergences, right? When the price is making lower lows and your oscillator is making higher lows, this is called a regular divergence. A hidden divergence is a continuation pattern where price is making a higher low and yet the oscillator is making a lower low. When we are looking for CVD divergences, we want to look for what is a hidden divergence. Now, if anybody out there is a TA snob, you're going to say, Jason, that's not a hidden divergence when you're looking at CVD. You're right. It's technically not a hidden divergence, but it looks the same. And so for the sake of people understanding what they should be looking for when looking at CVD, you can think of it as you're looking for a hidden divergence, as if you were looking at the RSI. Okay? If we see price is making a higher low and the CVD is making a lower low, this is a CVD divergence. And here's why. Here is why. If we know that delta is getting lower over time, this is telling us that people are market shorting, right? They are hitting that sell button with market orders, and more shorts are being marketed into than longs. So if we're looking at a footprint chart and we see that the CVD is getting lower over time, we should assume that the price should follow, because if more shorts are opening up than longs, it's only logical that price would come down, because market orders are driving the movement of the market. But if the price is actually getting higher over time, and yet CVD is getting lower over time, this is telling us that there are large limit orders absorbing this massive amount of market shorts coming in. So let me kind of draw this out for you one more time, and then we're going to look at real life examples. But if I have a downtrend like this, okay, low, lower, high, lower, low, lower, high, lower, low, lower, high, higher, low, okay, and my CVD is doing something like this, where it's coming down, you know, coming down, and even still coming down, okay? What this is telling me is that when we come to this level, okay, there was a large limit order that got filled here, and the retail traders don't know it, right? They think, man, we're in this massive downtrend, I'm just going to keep shorting this thing down. And so the CVD coming down is telling us that there are market shorts entering here, there are market shorts entering here, market shorts entering here, okay? And for some reason, the price is actually now starting to make a higher low. How is this possible unless there is a large limit order that's greater than all the market short orders that are coming in, okay? So in other words, if we have here people shorting right here, let me use a different color. We have people, actually, you know what? I should probably, for CVD, I'm going to go ahead and use this yellow line. Okay, so CVD is getting lower and lower, okay? And we have the limit long right here. Let's say we have a limit long, and this limit long is equal to, let's just, for example, limit long 100 million, okay? And we have these shorts coming in, right? People are thinking to themselves, man, we're in this massive downtrend. We just lost, let's say, for example, that we literally just lost a support, okay? We just lost support. This was support right here, and we lost the support, right? I'm going to use a black line for our support. We had a support line right here. People are like, that's it. We've broken down from the support. I'm going to go ahead and short this, okay? And so people now are entering shorts here under the resistance. They think, oh, we're retracing, retesting a little bit. Let me short right here. Let me short right here. People are shorting right here. But then we see the price kind of do this. Well, what this is telling us is that these shorts that are coming in here and causing the CVD to get lower and lower and lower, because they're marketing in, and CVD is only showing us market shorts. These market shorts, okay, each one of these red lines right here would represent a market short order. These are not more, they are not greater in quantity than this $100,000 limit long. And so let's say that each one of these four shorts was 20,000, Okay, each one of these 4 shorts was 20,000. That means altogether we have 80,000 shorts coming in. And because we have 80,000 shorts marketing in, the CVD is getting lower. But we have 100,000 right here of the limit long. And so these shorts are not able to be greater than this limit long. And so the limit long, once filled, is going to win out. And then if some market longs start coming in, we are going to get a move to the upside. So we should be looking for CVD divergences to give us hints that there are large players holding price at a certain level. Let's take a look at some actual pictures here, okay? Right here, we can see we have bearish CVD. Why do we have bearish CVD right here? Price is making lower highs, okay? Price is making lower highs, and yet CVD is getting higher. What is this telling us? This is telling us there are many, many people marketing long. And over time, from this peak to this peak, more people are marketing long than marketing short. So we can think of it as an algebra equation in a lot of ways, right? I mean, we're solving for X and the limit orders are X. So let's say that we have, 300 million longs, right? Plus X equals lower price. Okay? If we have 300 million longs coming in and CVD is getting higher over time, like this, but price is getting lower over time, what's the missing variable? The missing variable are massive limit shorts. Okay, so X is massive limit shorts. Massive limit shorts being filled. Okay, this is how we are going to use CVD. We're going to use it to fill in the blank of what should be happening but isn't. Okay, and a great example of this locally would be something that we just saw recently. Because Bitcoin actually is right now, we did get a move to the downside right here. Okay, we got a move to the downside right here, and this happened on a very, very local time frame. But if we go to our chart and we go down to let's go down to a lower time frame, like the 2-minute time frame, okay, we can see very locally here that hang on, let me go down to an even lower time frame. Okay, right here, guys. Here's what we see. We see the price is making a lower high, but we see that over time, CVD is getting higher, okay? And what was the result of that? The result was we got some movement to the downside, okay? Now, this is on a very, very local time frame. We can do this pretty much on any time frame, but this is just the most recent example that I can think to show you. Right here, we have a high, we have a lower high, we have a high on CVD, we have a higher high on CVD. What is the result? The result is we get a move to the downside, right? Look at this. We come down. Why is that? It's because people were trying to long the breakout because we're in this bull flag thingy, and people are trying to long right here, and they're like, oh, this is it. We're breaking out. We're going to break out, right? And we can see CVD is getting higher, but there must have been limit shorts here that brought the price down, okay? Now, this can be done locally and over time, and we're going to get into exactly how we can look for these divergences and how we can actually trade them actionably, okay? How we can trade them actionably. So, we can look at CVD over the course of a range, okay? If we see that we are consolidating, let's say, for example, in a bull flag, or a bear flag, if we see over time the CVD is getting higher, but every time we make a high in the price, it's getting the price is getting lower, we can then kind of assume that when we do break this range, it will break to the downside, okay? And here's an example of bullish CVD. We can see here, CVD is getting lower over time, and yet the price is making now higher lows. Now again, this is very, very similar to a hidden divergence, right? A hidden divergence. Price is making a higher low. The oscillator is making a lower low. We come back to our CVD picture. We can see price making a higher low, CVD making lower lows. It's not really an oscillator, right? Because it's a cumulative running average of the delta, but we're going to be looking for that same thing, right? We want to see that the over time the delta is making lower peaks as the price is making higher peaks. Now, notice this. We can look at this over time, and we can do it very locally. So we can see that during the course of this entire little period of price action, not only do we see the CVD divergence from this low over here to this low over here, but if we zoom in, we can also see very locally that we have a prices. Actually, this picture doesn't show what I am looking for. This price does not. This picture does not show what I'm looking for. What we also would like to see sometimes is on a higher time frame, we see it on a long-term scale, and on a lower time frame, we will see right as we get this reversal, we will see that the CVD will also even be getting lower than that. So let me show you what I mean. I'm going to actually go to a live example that happened a few days ago, where we had a very local CVD divergence, which gave us a move to the upside. Okay, so let's come down here, see if we can find it. No, that was not it. All right, here we go. Look at this, guys. Look at this right here. We can see that we have 23 million. This is a great example of a CVD divergence. We have 23 million volume. We have negative 7.6 million delta. This is telling us that there are 7.6 million more shorts than longs, okay? And then what happens? We see the price starts to reverse. Now, this immediately should be tipping us off, saying, you know what? There's probably a large limit order down here, and now these shorts are trapped, okay? But added confirmation is this CVD divergence, where we see, okay, price now has come up and it's made a higher low, okay? We have our first low right here, and then we have a higher low right here. But look at CVD. CVD has actually come lower. What is this telling us? This is telling us that although there are shorts opening up, okay, we actually see this happening here. We see our open interest. We see open interest is actually increasing. We see shorts are opening up, but for some reason, price is coming up. We see CVD getting lower over time, but price is coming up. Why is that? How is that possible? The only explanation, again, is that we have our good old equation here. We have, in this case, we have shorts. We have 300 million shorts plus X equals higher price. Okay? Well, we should say 300 million shorts plus lower CVD plus X equals a higher price. What is the only thing that would fit into this equation that would make sense? The answer is massive limit longs. And so when we see the CVD getting lower, when we see all these shorts opening up right here, when we see that these shorts are now trapped, the only explanation is that all these market shorts are being absorbed by a large limit order. The large limit order is now filled, and when price starts to reverse and we see all these shorts trapped, and now we're seeing these market longs come in because we see net longs increasing, this would be confirmation of the CVD divergence. And so this brings me to my next point, which is very important, and that's confirmation of CVD divergences. We have to be very careful when we're trading these things that it's not something called leading CVD, okay? And here's what I mean by that. Let's talk about leading CVD, okay? You have to be careful when longing or shorting CVD at the top or the bottom, because CVD can be what's known as leading. That's why you have to wait for confirmation in the CVD divergence and trade above or below the divergence, a change in market structure. And we're going to get into this more, but let me just read this and then we'll discuss it. We can have bearish CVD and price just continues to go down and the divergences disappear. Actually, I think I should say we can have bullish CVD, but price just continues to make lower lows and then those divergences disappear. That's why context is so important, and you have to wait for a market structure change. This will take time and experience, but basically you have to be patient when trading these things. So right here, we could see that potentially we have a bearish CVD divergence, right? We have a much lower high, and CVD is like making a much higher high. So you might think to yourself, oh man, this is a great time to short, right? Look at this CVD divergence. Well, if we wait a little bit longer, we can see that the price continues to go up higher than where it first started. So the first picture, price is right here, and we had what looked like a CVD divergence. Now the second picture, price is coming up here, okay? Still could technically be a CVD divergence, but how would we know, okay? How would we know? And then the third picture, the CVD divergence is completely invalidated because the CVD has made a higher high, but so has price. So we have to understand that sometimes if we have a lot of market longs coming in, there are not going to be any limit shorts there absorbing the market longs. So how will we be able to know if we do have that large limit short absorbing the longs, or if simply we're just going to blast right through and this divergence, what we thought was the divergence before, right, where we have the lower high in price and the higher high in the CVD, how do we know if it's legit or not? Okay, there's two main ways that we can know. The first way is a market structure change. Okay, this is very, very important. We won't know if the divergence is official until, let's say we're in a downtrend, like this, like this, like this, like this, like this. We won't know if that CVD is official until we have a market structure change. Okay, so if CVD is getting lower and lower and lower and lower, right, we won't know if this right here, okay, when we see CVD getting lower here, okay, and the CVD is getting low over time, we won't know whether or not it's leading CVD until we actually see that higher low right here, okay, until we actually see that higher low. So we're looking for a market structure change. This is very important because let me just quickly draw this a little bit more clearly. We have CVD is getting lower. Hang on, I'm not good at drawing, guys. Okay, so CVD is consistently getting lower, and we might think to ourselves right up here, okay, look at this, price is getting higher, but CVD is still getting lower. This is a bullish divergence, right? Wrong. We need to wait until we have a clear market structure change, until we clearly see that pivot, okay? That is the first thing we're going to look for. The second thing, and the most important thing that we're going to look for, are trapped traders. So the best CVD divergences are going to come about when we see massive amounts of volume coming in, massive amounts of volume, abnormal amount of volume, okay? Now, people always ask, how do we know, if it's high volume, right? Well, it's relative, right? It's all relative. It's relative to the market context. If you're looking a few candles back, right, and you see that we have, 7 million volume, 6 million, 5 million, 7 million, 11, 11, 6, 2, 7, and then all of a sudden we have 23 million volume, okay? This should catch your attention. We have a lot of volume coming in, okay? Which means potentially, when we see high volume, we need to think to ourselves, because we have all this volume coming in, because we have all these shorts coming in, there is the potential that millions of shorts could be trapped here, okay? Now, how will we know when these shorts are trapped? Very simple. When the price comes back above where these shorts are. So we can see starting right here at about 38,350, we have all these shorts opening up, and then we have 1 million, 2 million, another 2 million, another 2 million, another 2 million, give or take. We have 10 million shorts down here on average, right? I'm just using bad math. As soon as we see that the price has come up trapping these shorts, and as soon as now we see the market structure change, right? Look at what's happening. We have a purple candle coming down. We have two blue candles coming up. Then we have another purple candle coming down, right? And when this purple candle comes down, now we see the CVD divergence. We see, okay, we've made a higher low, but the CVD has made a lower low. And now, what do we see? Now we start to see market longs coming in, pushing the price up. For the safest trade, you would want to wait until you've confirmed that market structure change. We put in our low, our high, our higher low, our higher high. Upon that higher high, what do we see? We see millions of trapped shorts. We see market longs coming in, telling us that there was a large limit long order here that got filled. Now we're starting to change market structure. Now the market longs are coming in, trapping these shorts, and away we go, right? And that's a very nice long trade right there, okay? So this is what we want to wait for. We want to wait and see that we have the market structure change, right? Let's say that we have millions of shorts right here, okay? Our CVD is getting lower and lower. And so now we see the CVD divergence. Price has officially changed market structure on the low time frame. The CVD divergence is there. Now let's say we start to see the CVD come back up, right? The market longs are coming back in, trapping these millions of shorts, and away we go, right? The shorts are trapped, the market longs are coming back in, we have our divergence, and away we go, okay? Now you're not always going to see the CVD divergence. The CVD divergence just makes it much more abundantly clear that you are going to get a reaction there. And personally for me, I like to combine this with the use of my favorite indicator, Market Cipher. And the reason is because Market Cipher will give me an added layer of confirmation. Actually, I personally use ExoCharts to give me an added layer of confirmation for Market Cipher. Now, if we go back to the, for example, let's go back to that divergence that we had there. Where was that one? It was right here, okay? This was at March 8th at 1:30. So let's go to our Bitcoin chart. And let's go to March 8th at 1:30. Right here. Okay? And let's go down to a lower time frame. We can see that, and you can use also like the RSI or whatever indicator you want to use. You know, it really is up to you. Some people don't use other indicators. Personally, for me, I really enjoy Market Cipher because Market Cipher takes all the noise out and makes it very relaxed, very, very relaxed, because you can see what's happening with the money flow and you can see what's happening with the momentum, and you can take that into consideration as you are using your I'm sorry guys, this is taking so long, isn't it? Well, what the heck. I have a captive audience. All right, 8 o'clock. We need to go to 1 o'clock. 5 o'clock. Aha, here we go. So, Market Cipher B, we can see here that as we are coming to our area of support, not only is the momentum coming up over time, but also the money flow is getting higher over time. And not only that, but we have a very local uneven butt cheek pattern right here as we hit that low, okay? So all things are pointing to the fact that this was a significant bottom, okay? And so that is how you're going to use CVD and CVD divergences in order to enter trades, okay? And again, you don't always have to see the divergence. What's very important is that the traders are trapped. And more so than that, if you see trapped traders and you see Market Cipher divergences, that's a very, very accurate signal. All right, guys. Well, I hope you enjoyed this session on CVD. And I will see you in the next session. Peace.